Hello, my name is Sergey Gorchakov. Welcome to this mini course, Accounting of Crypto Assets and Transactions. Let's start. First of all, who is this course for? It's for accountants, for auditors, for finance managers of companies who work with crypto. It could be also useful to top management of those companies who wants to get some insights about how accounting of crypto assets should be done. Of course, there are numerous courses on crypto topic already. So if you need more details, especially on the technical part, I would recommend to Google for them. One of the good channels I found, I don't know them personally, they have more than 1 million followers, for example, this whiteboard crypto. So if you go there, you Google for Uniswap or any other topic, basically, you can see that their animation is quite useful and clear, and it is easy to understand. And even, for example, Uniswap version 3, they will try to explain what is this all about. A small disclaimer. Of course, if you don't have accounting knowledge, you don't know what double entry is, it would be difficult to follow. And also, if you don't have any crypto knowledge or you don't have interest in it, it would be also quite difficult to go through it. Once again, if you work for a large company in crypto, for example, a crypto exchange, somewhere in operations or finance, but probably you would know more than I'm going to go through here. Although, of course, when we look at FTX papers, which have been made available to the public, it is clear that they use QuickBooks, a good system, but maybe not the best solution for a crypto exchange. A few words about myself. I'm a chartered accountant. I have more than 20 years of finance experience, and I'm in crypto personally, professionally since 2017. I led a regulated stablecoin issuer. Basically, I managed everything from scratch. I'm based in Luxembourg, and you can find my profile. So feel free to follow me and get in touch. Okay, of course, we will discuss some topics in crypto, especially those which I believe are quite important for the general understanding of how crypto should be accounted for. And we'll go through accounting methodology. We'll take a look at some transactions and how they should be booked accounting wise. Of course, we've seen the rise of crypto assets, and we'll discuss briefly use cases. We'll take a look at common asset types. First of all, cryptocurrencies, stablecoins, and some others. So, use cases. Even traditional businesses started using crypto in their everyday life. For example, first of all, to increase sales, they started accepting crypto. And there are basically two ways how to do that. The first way would be to do that through an intermediary. They could be a company which would accept crypto, of course, at a higher fees um, charged for that, and they would transfer the fiat part to the business for those sales. So in this case, probably nothing happens and you don't have any crypto exposure. But if we speak about uh, another case, when you just accept crypto against your sales, for example, stable coins is a very common example here. When you would accept USDC, it means crypto would go to your balance sheet and you have to trade it later on, or maybe pay your suppliers and so on. And actually, another use case here is when you pay to your freelancers or subcontractors or service providers, especially when they are based in different other countries. In many cases, it would be much easier and less expensive from transactional point of view. So transaction fees could be much less compared to other methods. For example, credit card payment or SWIFT transfer. And when you pay in crypto, especially stable coins directly your vendors. And of course, the biggest case here would be investments. So I guess there are much more companies who have just invested in crypto this or that way. So yeah, it becomes more and more common. And of course, on top of that, there are a lot of native crypto businesses such as price oracles, miners, validators, DeFi projects, and traders. Some of them don't even have a legal entity, but of course, there are more and more companies who wants to have a legal entity. Why? Because they gonna pay local taxes when they pay salaries. They might be paying, of course, corporate income tax, and they need financial statements for that, on top of different kinds of tax returns. And they would also need audited financial statements in case if they work with international investors who prefer, of course, to read audited financial statements. So let's move to the blockchain. It's quite important to understand what this is all about. To some extent, it's similar to an accounting software. Why? Because we also have, for example, when we think about QuickBooks, we always have opening balance, we have certain transactions, and the closing balance. And it's pretty similar to what the blockchain has. So, for example, the first block, we can think of it as an opening balance. Let's say there was a block one which had a certain balance at 31st December last year, and it's our opening balance. And in block two, we could have had certain transactions, ins and outs, and we will have a closing balance too. And so forth. But the difference with the traditional accounting system is that those transactions cannot be altered, and it means that we come from block one to block three, four, and five. Of course, there are some mistakes on the screen, but yeah, it means that no any transaction could be changed, and the records are immutable. So whatever happened in the past cannot be altered compared to the accounting software, for example. So if you need to do more changes, for example, if you still need to pay to your supplier, you have to do that in future. And then when the new block has been formed. And because there is a cryptographic hash in every block, and so it comes not only from the current block, basically where you check that everything is consistent inside the block, but also the hash of the previous block is been taken into account. So it allows the blockchain to keep trace of what has happened before. So when the node who basically checks the consistency of the blockchain, rechecks everything. In there, it might confirm that the balance, the hash is correct and nothing has been altered. But of course, it's under the hood. For when we look at it, to us, it's just a final balance. So we can always know what is the balance in our wallet. Of course, we will take a look at the wallet a little bit later. So let's take a look at the blockchains. The largest two of them are Bitcoin and Ethereum. And of course, Bitcoin is the original cryptocurrency. It still has more than 55% in terms of value locked in it. And Ethereum is the second largest one. There are a number of Ethereum-based blockchains. So basically, when they copied and pasted this blockchain, and there are a lot of those blockchains which are still in use and they have significant values locked in them. Just to mention that there are more than 3,000 blockchains currently, and maybe there are between 50 to 100 blockchains which might have significant value and where you would need to do accounting. Why? Because there could be different assets which should be included in the books of your company. And apart from Bitcoin, there also could be some Bitcoin clones, of course, but apart from Bitcoin and Ethereum and EVM-based blockchains, there could be also some others. They could provide similar to Ethereum functionality, uh, but on top of that, there could be also completely different blockchains. It's also important to note about token standards. Well, as you might know, of course, they're fungible. They could be fungible and non-fungible tokens. So, for example, of fungible tokens is US dollar or USDC. So, what it tells us, of course, there could be different tokens, but when we speak about one single token, the number of issued tokens is practically unlimited. So, it means that, of course, there are certain rules in the smart contract, but when it comes to the features of this token, it means that it could be counted, it could be one, there could be million, and so on and so forth. When we speak about non-fungible tokens, they are unique and they have distinct value. And most probably, one similar, even similar NFT would be completely different from another one. And examples of that are digital art, collectibles, real estate deeds, or even some references to real assets. For example, somebody hypothetically could issue an NFT which is connected to the real painting. And there could be other standards, of course, and let's say there could be another one which could include both fungible and non-fungible tokens, and they could be smart contracts which could work with both type of tokens. It's ERC 55. Overall, if we speak about coins and tokens, originally cryptocurrency is a native token of the blockchain. So it's either BTC for Bitcoin or Ether for Ethereum, and it's basically value units which are native to their chains. They could be used for payments. For example, if we transfer one Bitcoin to another person, and we know if the value of the Bitcoin of one Bitcoin is 110,000. So when we transfer it to another person, it means we have transferred equivalent of 110,000. It could also store value. We'll know if we, even if we bought BTC for 1 USD quite long ago, or most probably we should have mined it at that time. But anyways, it still keeps some value, and of course it has the current value for what you can sell it. And it also allows to pay gas fees. In other words, fees which are used to transfer tokens, coins in case of Bitcoin to another wallet. If we speak about uh, Ethereum, Ether could be used also to execute and sign smart contracts. It could be also used, overall, all native coins could be used to reward miners and validators. But what is unique for Ethereum compared to Bitcoin, of course, that there could be a range of ERC20 tokens, and they're built on top of the existing blockchain. So it means that, of course, the native currency, the native cryptocurrency is always uh, unique, but you might have quite a range ERC20 tokens. And there are different types, of course, and the most well-known are stable coins, meme coins, and altcoins. And if we speak about USDC plus USDT, they dominate in the stable coins. Although we have witnessed that there could be different assets, for example, gold, silver, so on and so forth. Meme coins, of course, Dogecoin is the most well-known one, but they often have they are often quite speculative and they are of high risk. Another type of tokens is utility tokens. So, for example, they could provide some access to a platform, or they could be provided to vendors as a reward. For example, if you are an oracle on Chainlink, you provide some real world price references, you will be rewarded by link token. And of course, you could sell it, you could pay your suppliers, so on and so forth. Or you could trade it for another stable coin or for fiat. And in case if Chainlink, for example, originally issued or created or minted, as they say in crypto, when they minted these tokens, it was just initially a prepayment for future services, accounting wise. And then maybe the last of the most significant tokens is another type, security tokens. Um, but because of strict regulation here, there are less and less new security tokens in there. Of course, there was a spike like around 7 to 8 years ago, but right now they are less common. Anyways, they could be still in your portfolio, and technically, it should be treated, accounting wise, it should be treated as another token, most probably. If we speak about when it was bought by the company. Another important concept of blockchain is a smart contract. So basically, it has basic features. It's self-executing, it's immutable, it's transparent, and it's trustless. Basically, all the definitions speak for themselves, but trustless, for example, means you don't need to trust the other party. So as long as the conditions have been fulfilled, it will be executed. You can compare the smart contract to a vending machine. Uh, for example, it's a nice picture. And for example, we have a snack here for $5, and of course, if we put $1 or $2, nothing happens. You might just claim them back. But when you deposit, let's say $10, you would get a change, and you will get your snack in the end. And of course, a smart contract is just a program which works on blockchain. It basically has a lot of ifs, thens, whens, and it has different triggers. And in the end, some actions could be executed. And it's been used in DeFi for NFTs and for token swaps, for example, and in some other cases. One moment. So another good example here could be KYC and AML of crypto exchanges. So we know that crypto exchange might give us a wallet address, and probably you could have noticed that what typically happens, there could be some time between when you send some crypto to the address provided, which is the address of the smart contract. And after, first of all, the crypto exchange checks whether you have passed KYC clearance, and it probably does an AML clearance. In other words, checking that whatever happened there on the uh, well, first of all, that all the assets have come from white wallets and they haven't been stolen, so on and so forth. So there are certain procedures, and only after that they could be deposited into their technical wallet, and you could see the balance eventually in the end. So the usage is the usage or the possible usage of crypto of smart contracts on blockchain uh, is quite diverse. And if we speak about different blockchain types, there could be blockchains based on uh, proof of work, such as Bitcoin blockchain. What happens here? So of course, miners try to mine Bitcoin. We all know that. And if that happens, we have to recognize revenue. But what is also important here that when we send something on Bitcoin, let's just go to a Bitcoin scanner, which allows us to see transactions. Uh, what is possible here. So when we assume that we are able to spend certain amount of Bitcoin as gas, but if we spend less, it could come back to the same wallet. For example, in this case, it's just random transaction. What we could see here that certain amount of Bitcoin was sent out of this wallet and it came to another wallet. And okay, there are no any significant other transactions, but just in case, it could some a small portion of what was sent here, and because it's the native currency of the blockchain, so some part of that could come back. For Ethereum, a proof of stake is being used. A proof of stake means that those validators who want to work currently on Ethereum, what they do, they stake their Ether on blockchain and they are able to share revenue of those transactions which have been validated by them. What is also important to note here, of course, there could be different numerous transactions, and it's not only one or two transactions, there could be quite quite significant transactions. For example, you could see 20, 30, 40 wallets in the same transaction. What is also important to note here, for Ethereum, we use Etherscan, for example. It's the most useful, but probably there are different scanners which could be also another name is Explorer, so they could be used to trace all the transactions here. We also can go to any wallet, and speaking about the ERC tokens, for example, we could, when we go to the wallet, we could see any kind uh, of wallets. In this case, in this wallet, we can see only Ether balance with the respective valuation, but probably there are no any other uh, assets in this wallet. If we go just to another random one, okay, again, nothing. Let me view this one. Yeah, if we go to this wallet, for example, first of all, it has some balance in Ether, but it also has more than 200 something tokens. And you can see, of course, there are some legit tokens, but what is important, because anybody can create essentially a smart contract for a token on this blockchain. So there are a lot of so-called spam tokens, and most probably you won't do anything with them. Of course, you will have to account for USDC here, especially with such a balance, but if you go to, yes, let's say this one, it's quite minor, although it has some value. For a million tokens, you can get 1 cent. But starting from this one, there are a lot of tokens which are so-called spam. So most probably you just don't need, you just have to omit those in your transactions when you do, when you work with this wallet. What is also important to note, overall, the time which has been used on blockchain is UTC. So, for example, here, if we go to any time, you can see that it's UTC, it's 13 hours. And for example, my laptop currently shows 7 p.m. So 13 is 1 p.m. And you can see that there is some difference. And usually the approach is that whatever happens on blockchain, you take the same date. So, for example, 31st December 2024, 23:59 is the last second you would take into account as the closing balance of the last year. Although UTC could be technically quite different from your real time zone where your business is based. But of course, it is usually up to the company how they would like to do accounting of those transactions. Um, there are also, like we looked at before, there are also EVM compatible chains. Actually, EVM stands for Ethereum Virtual Machine, so basically there are quite similar blockchains. And what is also interesting, they could use Ether uh, quite similar to Ethereum. So basically, it's the same native cryptocurrency, but some others could have different names. Or Avalanche, for example, it would use for main chain, they would use the same EVM, Ethereum-based blockchain, but some for two other subnets, they are completely different. So, for example, when you want to stake something on Avalanche, it would be a different subchain, and it means that you have to do accounting of those transactions. So, when you need to confirm that something has been staked on Avalanche, you would need to understand how this blockchain works. And of course, there could be other non-EVM chains such as Tron, Solana, so on and so forth. They provide similar functionality. And by the way, Tron is used quite widely for stablecoin, especially USDT transfers. Um, but it's a different blockchain. What is also important here to note that we took a look at Ethereum blockchain, and even here um, how it works. That the same wallet could work for different EVM similar blockchains. So if we go here multi-chain portfolio, we can see that there are different chains, and we can see some tokens. Of course, keep in mind the list is non-exhaustive. So first of all, you need to go through all the details here. You need to understand, what tokens, first of all, are in this wallet, and what tokens have some value, and whether you need to do accounting of those. But of course, besides that, you would need to check all other meaningful blockchains where maybe there are some significant assets in those. If you need to go through all the details, if you don't have any other technical tools, of course, you can see all the transactions here, especially with Ether, when you send something out, or they could be internal transfers and other tab in there. So when you can see some incoming transactions in Ether, and you can see also the gas fees paid for these exact transactions. Of course, there are some pending transactions right now, but after you have renewed the current page, you could see much bigger picture from the latest transactions. And of course, if you once again want to go to, if you want to check the previous balance, you can go there and you can check this wallet. You can pick up, let's say, any date, 31st July, so the last day of the last day of the previous month. Um, and you can see some balance. So, for example, they had this exact amount at the end of the day, or it could be, of course, any other day. So you could work here quite easily. You can always double check that once again. You could do the same with any ERC20 token. Let's say we want to check the balance of this token, but what we would need here, apart from the token itself, which could be just uh, paste here, we would need this address of the smart contract. How it could be found? If we go to Etherscan, and I noticed they had some USDC. So let's go to USDC. We just uh, can find the token contract right here, and we can paste it here, and we can check what was the balance of USDC in this wallet for this contract address. So you can see this quantity of USDC which was in this wallet at this date. Yeah, and so speaking about blockchains and explorers or scanners, of course, there is a full list. You can always Google it. It all depends on the blockchains and assets you work with. And you can always Google and find, for example, Bitcoin, Ethereum. They have their main links where you can find more details about the blockchain. Then you can find the explorers, for example, the most common ones for Bitcoin is blockchain.com. For Ethereum, it's Etherscan, and there are a number of EVM-based blockchains. Also, you need to Google here. For Solana, it would be Solscan, and for Tron, it would be Tronscan. And once again, for looking at this table, we can see that the native currency for Bitcoin is BTC, Ether is for Ethereum. Ether could be used in some other chains, but it could be the same way, it could be their own one. And Sol and TRX, the respective native currencies for those blockchains. And EVM, of course, it's widely used, but for example, for Solana and Tron, they have their own virtual machines. And of course, apart from Bitcoin, others might have other tokens, not only the native currency. What is also important to note when you work with your counterparts, sometimes I'll notice that I could receive a wrong wallet. For example, they got the last three chars by chance, whatever happens when forging those wallets. And of course, it's not possible to find them. So first of all, you can always find whether the wallet is has been provided correctly. So first of all Bitcoin wallets are case sensitive. Um, and for example, this wallet number, if you just change one char here instead of lowercase t, you would use capital T, it would be a different wallet. So keep that in mind, right? And you can see that the original wallet started from one and had this structure. Later, they started using three, and the length was still 34 after that. And the most wallets, current wallets, start from BC1Q, and they have the length of 42, but the next step is wallet started from BC1P, and they are not widely used yet. Also, it's maybe worth to note what is a wallet. It's a digital tool which stores the public and private keys needed to access and manage your cryptocurrency on the blockchain. It's like a technical definition, and of course, in simple terms, the wallet is the address by which we can find some balances, what is in there and how it can be evaluated. And of course, we can see the history, we can find the transactions. So when we do accounting, of course, in simple terms, a wallet could be mapped to a GL account, or maybe you might select another approach. You might have, or let's say, one GL account for all your wallets, so on and so forth. Let's briefly take a look at transactions here. So the transaction on Bitcoin we looked at a little bit earlier. For example, we can see that this wallet started from one. So it's in here. Probably we won't be checking, but the length, because it's a real transaction, the length will be 34, and it was sent to BC1Q. So this type of wallet, and probably it is the length of it is 42, and also to another wallet which has the length of 34 and which starts from 1. And what is also important to note that typically the most recent wallets save on fees, because it's already they have some improvements, and it costs less to send assets between those wallets or from out of those wallets. Okay. When we take a look at Ethereum-based wallets, basically it's not only Ethereum but all EVM-based chains. So the structure is like that. It starts from 0x, and there could be 40 chars characters, but they could be in hexadecimal address, so it means they are not case sensitive. So when you have this kind of wallet, when you so your lowercase f could be capital one, and basically it's the same wallet address. Maybe it's not that useful, but once again, keep in mind that sometimes your counterparts could provide, let's say, all capitalized or a little bit changed number of the wallet. And of course, when you Google or you just do lowercase or you do capital case of all the charts, yeah, maybe you would find something like that. So it's also important to know that sometimes people approach me and they say, "No, look, I have a wallet, but I can't find anything about it." Yes, but because you have to do something with the wallet number. Another chains, for example, Tron, Solana, they have case-sensitive wallets. They start from TR, and for example, here usually it has 44 characters. Mm, um, yeah, and Avalanche, the main net, has two formats. The first format is similar, is just the same as the Ethereum one, but X chain and P chain might have something starting from X, AVAX, like in this case. Like I said, it's quite important, in my opinion, to understand that, because when you talk to somebody who works in crypto, you should know that you should speak the same language. And if everybody might have a mistake, and when they send something wrong, you can always check that. And of course, you can go to Etherscan, you can paste this wallet address, whatever was there, and you can find the balance and all the transactions of that one. Let's speak about confirmation of ownership. Of course, when you have some wallets on blockchain, it's important for an auditor to confirm this ownership. And you might think, okay, what if we do something like PayPal does? Let's send really small amount of this wallet, and they would confirm us that they have received, for example, 33 cents. And in this case, it's probably not the best solution. Why? Because anybody could see that in blockchain. So I believe there are two basic ways how to do that. You should either receive the confirmation that they have opened their wallet, they can see the balance of the wallet from the inside. Of course, it depends on the wallet type, but let's say if it's MetaMask or any browser wallet, they just enter their password. Of course, you shouldn't be requesting their password, but you could confirm a screenshot out of this wallet that they really have access and control it. Or they could be a written confirmation, for example, on a company letterhead or signed by an individual that we do control this wallet, and whatever happens in it, it's the part of our business. And yeah, speaking about the types of the wallets, there could be hard wallet, something similar to a flash drive, a flash stick. So when you unplug it, it's not possible to access it, and only when it's connected to a laptop, and of course it's not in a safe or something like that. So only after it's been connected, you can enter your passphrase, and you can um, basically send out something and send out of this wallet. Our soft wallet, it's all kinds of wallets. They could be on iPhones, they could be in browsers, or there could be even some other apps on laptops, something like that. CX wallet is also here. Why? Because you can do several transactions, but once again, it's important to have CEXs in the infrastructure. They really help a lot to connect with the real world. But once again, when you keep any significant amounts in there, keep in mind it's not you, but the crypto exchange who controls the wallet in the end. Now, of course, you do control what you send out uh, of this wallet and so on and so forth, but it's like a bank, right? Uh, it's reliable, but to a certain extent. They also could be custodial solutions of different kinds. For example, when you have a large company with some treasury approval levels, and for example, then there are certain matrices how transactions should be approved when you send out something. Let's say one BTC is okay to be approved by one man, above 10 BTC it should be approved by two persons, and so on and so forth. It could be set it up here, and they might even have a solution. So let's say when it's a cold wallet, we just can plug it. So basically, they have something like that. Then plug it and put it into a safe, and you cannot access it before you really tell them that you need to do some operations with it. Okay, just to keep that in mind. Uh, One of the use cases on Ethereum could be bridges. It's not just one chain, but for example, let's say we need one asset to be used on another chain. So what we could do here, we could create a connected, or we could create two connected smart contracts, one on Ethereum, another one on Polygon, and we might lock certain amount of Ether, for example, or any other asset. It doesn't matter which asset you're gonna uh, transfer from one chain to another. So you look certain number of tokens of one asset in this smart contract. At the same time, the related contract issues or means uh, the same amount of the same token or similar token. It could be wrapped Ether, for example, here on this chain, and you could use it right there. Of course, in many cases, you won't be doing that. If you do that, for you, it's just transfer of the same asset. And if you don't use different GL accounts for Ethereum and for Polygon, it could be just a, an internal transfer, which you don't even do accounting of. But in many cases, probably somebody has done that for you. And what you could do, you have certain assets on Polygon, and you just swap your asset, your existing asset on Polygon against that required asset, and that's it, right? I think it's good to know how it works. Uh, Also, what exists here, some rep tests. Let's assume you don't want to have anything with Bitcoin blockchain, but you have some quite a number of assets on on Ethereum blockchain. And what could be done here? It could be somebody else. They could log BTC in a technical wallet on Bitcoin blockchain. And what happens at the same time? They issue wrapped BTC on Ethereum blockchain. And of course, it becomes a new asset with the same basically features of, I mean, it has all the features of a token on Ethereum blockchain, but it has the value of BTC. Of course, what is important here that there is only one smart contract like that, that there, if the price moves here, it moves here as well in the same direction. But I guess there would be arbitrage opportunities, and of course, I guess there are a lot of people who is looking at it. So let's say let's don't consider that. Long story short, when we have this wrapped BTC, I guess we can do the same things we could have done on Bitcoin blockchain. And furthermore, it could be staked into a different project. It could be swapped, so on and so forth. And one interesting case is that sometimes you cannot use Ether directly on Ethereum, and they could be wrapped Ether. So there is a smart contract where you send some Ether, and in the end you get wrapped Ether, which once again could be used in all the DeFi projects, so on and so forth. Mm, So I think we've taken a look at the main technical terms. So let's discuss accounting challenges which we might have with crypto. Of course, it's high volatility and valuation. So you have to know how you would value your assets, right? There should be a lot of technical tools. So it doesn't work like, okay, I have my wallet. Of course, at least you know what is good. They have added dollar equivalent to the blockchain, but it's not always possible to get the full picture. Like, it's not possible to do all the accounting transactions directly from blockchain, especially when you have hundreds of thousands transactions. So you have to know all this kind of stuff. You have to know different protocols, products, assets. It's also there's no global standards, although there are a couple of regulatory standards, especially in the US and in Europe, but they are more about how to, from one side, to protect investors in crypto, and from the other side, to control what they how they move assets about between the crypto exchanges and other sources. So it's a little bit different concept, but it's not about how to account for that. And of course, it adds some complexity to transaction tracking. And when it comes to tax compliance, it's also quite challengeable, especially when you have absolutely different, not only definitions of when there is, for example, when you have to account for tax, whether it's, between when you originally bought the first asset or you sold the last one or something like that. But it's also about many other different things. It's just not unified. It's completely different in different countries. So yeah, it could be challenging, and of course, you need to talk to your tax specialist in your jurisdiction. So let's take a look at basic transactions. So of course, there is nothing difficult here. I even haven't included any numbers. So when you buy crypto, you just record them at cost in most cases. And when you sell them, you write down the cost and you recognize the gain or loss. And there could be some fees which are typically incurred directly. So if there are some transfer fees, they would go typically to cost of sales or G&A, of course, depending on your business model. And in case of taxes, gain or loss is usually taxable and holding period matters. So, for example, you should apply capital gain rules. Uh, Also, one important point here is when you work with crypto, and for example, you transfer from one wallet to another, there shouldn't be double counting. Why this is important? When you look at a wallet, let's take a look just, at any random transaction, whatever it is. You send something from one wallet to another one. And by the way, they have a synonym. Here you could use your own synonym, but it's a topic for another discussion. Of course, there is always a technical address which starts from 0x, so the hash. And so you send from this wallet to this wallet. Let's assume you have two wallets. And when you fetch transactions from one wallet, it will have already debits and credits. You have to transform those into debits and credits. And when you do the same for the recipient, you will have the double entry of the same transaction. So you just need to post it once. It's pretty similar to bank statements when you send money from one bank to another one. So when you do debit a credit transaction in one bank, and when it comes to the second bank, you just have to reconcile and you have to confirm that this transaction has already happened. So I guess it's just one, it's quite important topic, but you just have to keep it in mind when working with crypto. There could be, of course, many other online transactions, and you just have to check what they are all about. So you need to understand what has been done there. Of course, if you just invest and you have one, two transactions every month, or maybe even less, there is nothing special. But when you have numerous transactions, or it could be hundreds, thousands of transactions, you have to do accounting properly. And you have to check what valuation methods are allowed. If it's fair market value, which shouldn't be the case, most probably under IFRS. If it is historical cost of if it is net realizable value, case of materials, and of course you should use cost valuation methods correctly. FIFO and weighted average are allowed both in IFRS and US GAAP, and of course the standards would cover most part of the world. Yeah, although there could be different local accounting standards, but most probably they would be quite close to one of those, either US GAAP or IFRS. LIFO would be prohibited for IFRS for sure, and it could be allowed for in some cases in US GAAP, and it is even encouraged, as I understand, in Germany, for example, but only for tax purposes. A lot of people ask me, what about HIFO? It's really important when we value, or when we do present our portfolio, we value it on the HIFO. It's like the highest in first out. Yeah. What happens here, once again, it's not allowed under IFRS nor under US GAAP. So, of course, it's really beneficial when whatever you bought at the highest price, you dispose of, quite quickly at the first place, and then you have, really good performance. Okay, look, we bought 100 BTC in 2012 when nobody knew about Bitcoin essentially, and yeah, the portfolio is $1 billion right now, something like that. But okay, accounting wise, it's not allowed. But of course, please double check. Maybe it is allowed in your jurisdiction. And of course, FIFO, LIFO, weighted average, I guess everybody knows these methods. Once again, LIFO is not allowed under IFRS, it's prohibited. But okay, first in, first out, last in, first out, weighted average. Everything is simple. It's also worth to note, especially, maybe it's not a point for the United States, everything is in dollars in there. But when you have different functional and reporting currencies under AS21, and let's assume they're the same in this case, so the functional currency is the same as the reporting currency, otherwise it becomes really difficult. So, of course, it's really recommended to do all the reconciliations in dollars. Why? Because it's like, it's the main currency of the crypto rate. Otherwise, it would be extremely difficult. I tried to do something like direct accounting in euro, but believe me, there could be much more challenges compared to when you do accounting of uh, transactions in USD first, and then when you do conversion into euros. And of course, you should take a look at the respective rates, whether you should take the exact rate at the time of the transaction. It could be okay in one case, if you just have one transaction, but from the other side, when you have one transaction, it's much easier. It's the same like, when you have one invoice in foreign currency, you just take the daily closing rate or maybe the weighted average rate would work fine, let's say for a month. And when you have, of course, hundreds of thousands of transactions, or when the precise rate is important, of course, you should do that. And it's applicable not only to the crypto price, but it's applicable to the your currency to dollar rate. For example, Euro USD. Of course, we could use daily weighted average or exact price at the time of the transaction. And also, it could be quite challenging to find the exact price of the asset at the time of the transaction. So that's why probably daily closing or weighted average rates would be just fine. And price sources, you could use Coin Paprika, Coin Market Cap, Coin Geek, or of course. So yeah, uh, of course, if you do, it's applicable if you do historic cost, and you should use historic rates and do an impairment. But if you apply fair market value, of course, it's much easier. You have the price at the closing date, and you have the respective value of the crypto assets, so nothing should be done there. Okay, just a small scheme, but I guess it just repeats what I've just explained. So when we speak about mining and staking, excuse me, when we mine in proof of work chains, So we just recognize when we receive, let's say, one BTC, we just recognize it at the value of the recognition, and we recognize revenue at the same time. Of course, it could be revenue or any other income, let's say, if it's not the main business, or it's just a kind of side income, or from the company point of view, it could be there could be any different account in P&L here, but most probably it would be revenue. When we speak about staked amounts, so you stake those amounts first, so you transfer them from the main wallet into the staked wallet, and when you get some revenue share, you just recognize that amount once again as revenue or as other income. When you receive payments in crypto, what you do, you recognize that you have received crypto asset, and it goes against revenue or sales if you do that right away, or in case if you settle the existing invoice, of course it goes against accounts receivable. And when you pay in crypto, it works vice versa, either expense or asset directly, or you pay the existing received bill. You have also to recognize gain or loss in case you use the cost model, and you write off the crypto asset you have paid out. And of course, at the time of payment in the US, this payment triggers the disposal event, and the gain or loss should be taxable or tax allowable. Another big concept is DeFi as an opposite concept to centralized finance when we speak about governments and central banks who control those transactions. DeFi is a blockchain based system for services where you basically don't need an intermediary. Of course, you would work via a smart contract which has all the rules in it, but basically you can deposit and earn some interest, which is what is called yield farming, or you can borrow some assets, of course, against existing assets you should have. If you don't have anything on the blockchain, you won't be able to borrow probably anything. It's not like in the real world. You always need to have kind of collateral. Well, of course, there are some loans, uh, like unsecured loans, but of course, even in that case, you have at least you provide at least your passport, something like that. So it doesn't work like, okay, I don't have anything, just give me everything. So when you lend something, you write off your asset and you have a loan receivable. When you borrow something, of course, you get this crypto asset and you have a loan payable. When you have some yield, you record either revenue or it could be other income, interest income, something like that. And from the tax point of view, it's often an ordinary income, and of course, it varies by jurisdiction. Let's consider transactions are in this very particular example of swaps in DeFi, and it's like Uniswap, SushiSwap, or this kind of web of providers which could really help. For example, when you just swap WC into USDT, of course, some part of that could be the transaction fee, but for us, because it costs what we do, we just swap wrapped BTC and we get USDT instead. So we just withdraw something from one wallet and we debit something into another wallet. So nothing special here. So it's just quite straightforward transaction. Let's assume we work on another side. We provide liquidity to the pool. Yeah, it's basically the second part what you could do there. Because of course, the pool works as long as there is somebody who has provided liquidity before. If there is no liquidity for certain assets, you won't be able to do this swap. So it's also important to note here. But okay, let's assume there is quite liquid pool and we have market rates in there. So let's say at the price of BTC of 60,000, we deposit 0.16 thousandths of wrapped BTC and USDT, so they should have the same amount at the time of the transaction, and it should be fair value. Okay, it's just how these swaps work. And if you need to see more details, please go to the YouTube channel I recommended. So they will explain much better why it works like that and some other stuff. But okay, let's assume we deposited it. So we deposited equivalent of $2,000, and let's assume it's our historic cost. So now we just bought it at the same price. Let's say after some transactions, so the prices went up and down, and it could have some time could have passed, and now in the end what we have 0.5 thousand for WBTC, although the price has gone up, and we have 1600 of USDT, and we got some fees in double for WBTC we got 60. Oh, excuse me, we got 50, and for USDT we got 60. So the fair market value would be 2,260. So if we work in the cost model, of course, because we disposed some amount, so it's 16 minus 5, which would be 11,000. We take a 60K, which is the valuation at cost. Or in this case, 700 should be written down. At the same time, we received 600 of USDT, and it should be some kind of income. Of course, it depends on the exact accounting rules. For example, if you just trade, you can show it net of any other fees, so it would be just one GL account, or it could be your main business. Doesn't matter. In that case, of course, it would be revenue and it would be cost of sales here. Anyways, 600 equivalent of USDT, we just got it here. We also recognize income on BTC and WBTC. Excuse me, there is a mistake. 50 is WBTC and 60 is USDT here. So when we recognize this income, uh, of course, we should have received it in our balance. So in total, our net effect is plus 10 when we look at the cost model. 250 is unrealized gain. It is a 5,000th of WBTC valued at the current price 110,000 minus the cost of the same amount minus 60. So 50K multiplied by 5,000, you would get 250. So that's what we get. And we can double check the total assets we have. 1,000 plus 1,000 minus 700 plus 600 plus 50 plus 6, so it's 2010. And if a fair market value model would be used here, we should have added 250 in the end. And of course, if we still work in the cost model, when we basically withdraw funds from Uniswap, we move it again back to the wallet, the amount should be this one. And of course, when only we dispose it, we should recognize the realized loss or gain in this case. Okay, I hope it helps to explain how this should be accounted for. Another example of DeFi is Aave, and of course there are a number of similar projects in DeFi, but let's take a look at this one. The first part, when you deposit, you can deposit your assets, and of course, you could have deposited USDT, for example, and after some time, when you take it back, it will accrue some interest. And how it works, of course, the rate is floating, it could go up and down. Yeah, but in the end, whatever you get, you could just take it back. And how it works, because there are other different counterparties who are ready to borrow against existing assets. So whatever happens here, let's take a look at details. If we go to the other website, you can see there are different assets. For example, USDT could be deposited at 372% currently. Of course, it's annual interest rate. Um, and you could borrow them at 550. let's take a look at the second example here. Okay, the same number. Let's say we have 16,000 for WBTC at 60K. This is the original cost. We deposited as collateral here, and instead we get 960 USDT. Of course, it's a simplified example. You should understand that you have to deposit more, but let's assume we do, because it's cost, maybe the fair market value is a little bit higher at this point. Yeah, and also keep in mind what is interesting about Aave and similar protocols. There are no any margin calls which would work like in real life. You would have a broker or a bank who would call you and they would say, "Please wire the missing amount by the end of the day," or something like that. Here it doesn't work like that. So most probably your position will be liquidated and you would lose money. So when you work like that, of course, your collateral should have some real space in terms of price movement. And keep in mind, if you deposit Ethereum or Bitcoin as collateral, of course, they could go up and down quite significantly. So keep that in mind. But once again, we are considering the accounting part here. So let's assume here we deposit something. After some period we have to repay the interest, which is recorded here as a liability, and as soon as we have started returning our assets, of course we return back 960, but 960 USDT. But what happens there, of course, at this point, there is not enough assets to be sold here, and there could be different options. Um, I don't remember exactly, but of course, it depends on the real case. And let's assume you have to sell WBTC, like in this case. Yeah, and why? Because let's say you used your USDT, the answer is simple, right? And you could have used it there, but it's not necessary that you could have earned something. Maybe you just kept it in your account. It doesn't matter. So you just don't have more assets in the end. So of course you have only your real asset, WBTC, and what happens here? Of course, the cost is 60. So you write it down. But at the time of the transaction, the real fair market value price is 110. So you have to sell equivalent of one WPTC, which covers 60 of historic cost and 50 would be realized gain here. Of course, you transfer that and you get back 15 thousandth of WBTC. You just get it back, and in the end you have it there. And of course the cost is 900 and 750 is unrealized gain here. And you can see this the perfect example, because it's important that, for example, you want to stay in BTC, but you need some USDT. In this case you can transfer your existing WBTC as collateral, and you can borrow a certain amount of USDT, and you could do whatever you want with that amount. And of course, in the end, you just have to return USDT, and you can get back your WBTC. And of course, probably in reality, it could be a little bit different. So if you could have returned a 960 plus 110 here in USDT, it could work a little bit differently. But anyways, it just illustrates how accounting of those transactions should be done. So you just really take what was done on blockchain and you replicate those transactions in books. Centralized exchanges, I wouldn't say it's a complicated topic, so it's really similar to already existing. Probably you could have had some brokerage accounts, some bank statements if we speak about fiat. Cryptocurrencies, of course, you can think of them as another shares or stocks, and it's just another type of how you would account for them. And so, of course, there could be different types of transactions. Centralized exchanges could be even used as a bridge. For example, you send USDC via Ethereum. or meaning that you receive them on the crypto exchange and you can send out them directly on Polygon or something like that. You could also stake crypto amounts in there, for example, USDC, USDT. Currently, you can invest at very favorable rates and you don't need any special protocols. You do that on centralized exchanges. And of course, when you move out, you can pay to your suppliers the same thing. So basically, you have to do the same accounting of all the transactions. So just think about crypto exchange as a combination of a bank account and some brokerage accounts. And yeah, also, in my opinion, it's quite simple. So fiat accounts, do accounting of them as cash equivalents. For trading accounts, you transfer the wallets. If you trade for fiat, you also have all those transactions. And if you have some staking movements, the same, you recognize interest as soon as you have received them, or maybe you have to accrue if it's a really long-term deposit. And futures account, yeah, basically the same rules as for a brokerage account. NFTs, once again, nothing special here. It's probably if you use a cost model, so you just recognize everything here, you would add realized gain or loss. And of course, there could be also royalties from NFT. In some cases, yeah, the same thing, nothing special here. US example of tax treatment. There could be capital gain and there could be creator income, which would be treated as ordinary income. Once again, look into details with your tax consultant. So overall, as we have gone through the examples of accounting transactions, so you need to identify the transaction type. So you have to really understand what is this all about. Is it just one transaction? Maybe there is a more complex transaction. What is happening there, like something like a swap or borrow a borrowing or against a collateralized asset, something like that. You classify asset or liability, you measure at initial recognition, you record a journal entry, you monitor for impairment or evaluation, unless it's a fair market value. Of course, you will always have the market price, and you recognize expected gain or losses. And when it comes to taxes, you apply tax treatment and you disclose respectively in financial statements if that's required. And let's now move to IFRS. So basically, usually crypto would be treated as intangible assets. And of course, we know typically we have amortization. So in this case, it would be like long-lived intangibles like land. We never depreciate land the same way we never amortize intangible assets because it is supposed to have indefinite life. It could be inventory, IS2 in some cases, and I also have seen in rare cases it could be IFRS 9. But of course, you know, it could be really challenged by your auditor. So if you really think it's the case, yeah, we will have a lot of conversations on the methodology. So of course, initial measurement includes cost plus transaction fees, but most probably they are negligible or they just don't exist, especially when you have to pay when you only send out some crypto assets. Fair market value, once again, like I said, unlikely, but anyways, it could change in near future. So ICE 39, as you might recall, there are two models in place. It could be either cost or evaluation. Cost model, you recognize it on initial recognition minus amortization, but once again, we don't have it here, right? And only impairment if fair market value is less than the cost, so we have to recognize impairment. And of course, we don't have uh, any other cost to sell. So yeah, in our case, it just only downwards. It's pretty simple. But there is also a possibility to apply revaluation model. But you should have an existing active market. Of course, if it's traded on centralized exchanges, it can be easily confirmed. Plus, if it's on blockchain, anyways, you could see that there are many users, many wallets, which where this asset could be transferred to and from. And impairment, if impairment happens below original cost, it goes to P&L. If you revalue it up uh, above the original cost, it goes to equity directly. But if it's reversed in P&L, for example, you had some impairment before, which was in P&L, so of course you reverse that impairment and you revalue up to the point. So if it's above the original costs, only after that it goes to equity. And of course, if the revaluation down uh, within the original price, the original cost price, the this revaluation should go directly into equity. So you just reduce whatever you valued upwards before. Also take a look at IFRS 15 fair market value considerations, but I guess it's separate topic about details how it should be done. So in some cases there could be some small changes, but overall it's quite straightforward. IS2 could be applied in certain cases. For example, when crypto is used as gas for crypto businesses or as a trading instrument, or when you really trade with crypto. So you have to use neutralizable value concept here, and once again, you impair if it's less than the fair market value minus cost to sell. So yeah, it's pretty similar to. I mean, in this context, you don't really have to do anything else, so it's uh, the same, similar to impairment concept. Of course, you just cannot revalue it upwards. Um, so yeah, once again, the practical example here with inventories, we have something for 100. Let's say if the cost was 100, but the current price is 120, we do nothing. We keep 100, of course. If the current fair market value is 80, we write down 20 at the month end. If the tangibles, let's say we have the same fair market, the same cost of 100, we check the end of period fair market value. It is 100. In this case, we revalue it upwards into equity, and of course, in case when we use revaluation model, so by 20. If it goes down to 80, we do the yeah, 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 we do only so we write down only 20 here, and it's in the case, of course, it's not like consistent, but let's say it's two different cases. But let's say in new period from 80 it went up to 120, so we reverse 20 that we had written down before, and we recognize extra revaluation directly into equity. And here, if last period it was 80 and now it's 100, so we just reverse 20, nothing else. Of course, in case when it's only cost model, it's pretty similar to inventories, so nothing happens here. And for fair market value, you have also cost 100. At year end, you record gain or loss directly. In case if the price goes up, you have 20 of gain, and in case the price goes down to 80, you have loss of 20. Also, it's important to note that IFRS 18, in case, of course, if when you have material operations with crypto, it prescribes to describe methods, assumptions, and judgments used in recognizing, measuring, and presenting cryptocurrencies. And IS-10, keep in mind, events after the reporting period, we have to disclose any material non-adjusted events. Once again, if only it has been significant. US GAAP they have just issued a new guide. It's applicable since excuse me 1st January 2025, and uh, most probably you would use that if you are in the US. So there are two types of intangibles: in scope and out of scope. In short, in scope crypto intangibles, and this is something new. You recognize them at fair value, and based on that, I believe the same approach would be implemented soon under IFRS. But okay, anyway, gains and losses go directly to earnings. For those intangibles which are out of scope, they are treated as definite-lived intangibles. So no amortization and impairment testing at fair value at the period end. Stable coins, they may be financial assets or crypto intangibles. Analysis is required, but for example, USDT is a American is an American stable coin, so it's been recognized as financial asset. Assets in custody, they should be recognized only if entity controls private keys. Otherwise, possibly irreceivable. There are also definition of how sale to customers and non-customers should be treated, and disclosure, fair market value methodology, impairment classification, and individual investment company specifics should be disclosed. And once again, keep in mind uh, okay, there is maybe small diagram here. Once again, when we compare US GAAP, and I think it's important. Of course, you always work either in one of these, either in IFRS or in US GAAP, or there could be some features of IFRS or US GAAP, depending on your jurisdiction. But I've included here, so it's really easy to understand what are the current trends and if there are some distinctions. So you could really see what is important in your under your accounting regulations. And of course, IFRS is more kind of substance over form. And if we speak about US GAAP, it's more rule based. So if it's prescribed to us to do like that, we have to do it. IFRS, it's more substance over form, and that's why I guess some companies might still apply IFRS 9 with certain limitations, but yeah, it could give a better picture. Here, personally, I would agree, but once again, it is what it is with accounting standards, and they have to go through different processes before they to be adopted. Okay, this is the comparison table, and I guess to sum up the classification under the main accounting standards. And once again, US GAAP moved closer, and just to mention that before it was issued in August 2023, I think US GAAP was much more strict compared to IFRS, and now I would say that US GAAP gives a little bit more flexibility. US GAAP requires fair value through earnings. IFRS allows treatment through equity, forward revaluations, which gives maybe smoother P&L. But uh, from the other side, it doesn't give a full picture. It's probably when you work with crypto assets, which are quite volatile. And as you might know, I guess it's more important sometimes to have a more precise picture. Anyways, IFRS also allows impairment reversals. GAAP does not. We all know that. Okay, and to sum up about financial statements, of course, on the balance sheet and statement of financial position, it's how it's been called now. We have to include it on the intangibles, equity, inventories, financial assets, respectively, or intangibles and P&L respect in under US GAAP. In P&L, it could be part of sales, cost of sales, admin, or other income or expenses amounts. So you have to really take a look whether it's It's worth to disclose it in a separate line item, but yeah, it's like with any other item. Cash flow, of course, you have to look at the nature of the underlying digital asset in the balance sheet. Whether it's part of working capital for inventories, whether it's investment activity for intangibles, because of course, when it's technically called intangibles, it means you have used some funds in investment activity, or it could be financing for in case if it's financial assets. Also notes IFRS 18 presentation disclosure, we've touched that. IS 10 events after reporting date, and under US GAAP, of course, it's different. It's just in the same slide, but if you work under US GAAP, fair value methodology, impairment rules, classification, including investment company specifics. Well, and here it comes to the project I'm working on right now. Of course, you could Google and find some other competitors of us, and here I have to sell a little bit. Sorry for that, but this is what we do here. CryptaCount. We have beta users currently, and they are testing our system, and we help crypto companies to do accounting transactions. And of course, you have to use maybe wallet and crypto exchange API integrations to download to fetch all the transactions. Sometimes it's possible to do automated reconciliations, and they could be tax reporting models. And for us, if we speak about CryptAccount, there is a diagram of the platform. So we have data layer where we have 40 plus main blockchains. Of course, we can connect a certain number of crypto exchanges currently. We could include some custody platforms. We could process all the transactions on the platform. And we could export everything into main accounting systems. We will also develop, it's not, we don't have that right now, but we have plans to develop API to get access to all our transactions. And we also will work with local tax advisors who will help us to prepare ready to use tax returns or some forms to be attached to the tax returns, both for individuals and companies in different jurisdictions. And of course, we have, if you looking wherever you're looking at, there is another product demo. Let's don't go into that right now, but overall, you could take a look or you could get in touch with us. And of course, we'll organize the demo and we'll be happy to accept more beta users who would help us in the development of the program and of the platform. Common pitfalls to avoid here, once again, you might be missing some transactions. So don't, of course, always reconcile, especially there could be challenges that whatever developers recorded on blockchain, it might not always be so obvious to accountants because we think something should be this or that way. But I've seen some examples when it's not so obvious. Of course, there could be mistake with wrong asset or transaction classification. Also keep paying attention to that. Don't ignore taxable events, like some countries allow LIFO and could be really beneficial. And when they encourage you to do something, of course, it'd be really beneficial when you save on taxes, or at least you defer paying taxes until some future. And or of course, in some cases there could be more complex issues. For example, some countries, as far as I know, they have rules when you, for example, exchange BTC to USDT. It's not a taxable event, but only when you change it into euro, into fiat currency. So it will be the taxable event. Yeah, and always document every step. Whatever you do, describe your process. Yeah, but it's like everywhere, I guess, not only here. Yeah. Once again, best practices. We recommend everybody to have accounting policies. You know, we please use specialized tools. I hope we have a full launch really soon, and we'll be happy to announce that separately. Reconcile regularly, stay updated on standards, and consult crypto tax experts. In specific countries, of course, they really know what they are doing because they really read the laws quite, in quite detail. So it's really important to be in touch with tax experts. And always check standards, like we've seen with US GAAP. It's now more, at a more advanced stage compared to IFRS, in my opinion. And I think that IFRS should catch up soon. So really, really, please follow up on that. Resources, once again, IS 38 and IS 2 are the most important. IFRS 9 to a certain extent. US GAAP standards are here. There is also a IRS crypto guidance, which could be available in your country, of course, depending on the exact name of how it's called in your country. And always take a look at industry and also asset specific white papers. There could be some features which would help you in the correct assessment of your assets. And Q&A, of course, it's not live, and we invite you to post your questions wherever you're watching it at or wherever you have found this link. So we will try to monitor all the channels and we'll try to come back. And please leave your feedback. We are really open to see whether it's good to develop it further. Maybe we would create a course which would be much more detailed, and please address, maybe you would have complex cases. Let's discuss that and try to include and present somehow the really interested cases should be considered, should be went through. So it's possible to do that. Please feel free to post your comments. And that's about it. So once again, I've just said about the feedback. It would be really good to see what you think about what has been presented today, and whether uh, you would like to see anything, let's say, in a presentation or in the software, in case you have used already something and you know some gray areas, so to say, which should be improved. And speaking about the slides, also get in touch, should you need them. They could be of some interest to you. Okay, so once again, thank you so much.